welcome Ofer Karliner from Magellan Infrastructure Fund for joining the Motivated Investor podcast today. Welcome, Ofer.
Thank you.
Now, Ofer, pretty keen to know, initially from a personal point of view, before we get into your asset class sector and what you do, is how did you get into investing in the first place, personally?
So I went through high school not entirely knowing what I wanted to do, to be honest. I was always had an interest. My father was an engineer, but we always talked about shares and investments at home. I was kind of tossing up between medicine and finance, ironically. My dad was trying to push me to engineering, that's another story.
Yes.
And then I guess when push came to shove, I decided, my mum was actually against, she was a nurse who was against me doing medicine, and got a couple of doctors in who were friends of hers to come and talk to me about not doing medicine, and ironically, which is not what you normally expect. And I just moved across into finance. So
I assume it must be the time constraints and lifestyle that doctors must
Pretty
have been
much,
the angle that mum was coming at.
Yeah, absolutely. You basically lose your entire 20s, I think, which was just trying to tell me.
Yeah, and do you find, obviously, that you've found your passion, you've been...
Yeah, I would have kept investing anyway. I've invested since I was at high school.
Yes.
And so it was always a passion of mine regardless. And then, again, my mum's kind of pushing me towards the idea that you should do what you really love.
Yes.
And I think intellectually you kind of go, I should go do medicine, it's what, get the marks, you should go and do it. But then, he said, I think the quote was, if you find something you love doing, you never work a day in your life, kind of thing. It's about finding something you really enjoy and sticking with it.
Fantastic, obviously, and good at what you do. So, Ofer, would you mind just by giving us a brief overview of the asset class that infrastructure is, its sort of key characteristics, and what makes it an attractive long-term investment?
Yeah. So I think it's important to really narrow down what you mean by infrastructure. So most people could have come at it from a view that it's assets that are essential for the efficient functioning of the community. So you get demand predictability. When the fund was set up many years ago, the view was taken what are investors actually trying to achieve, and that is effectively a defensiveness, a low correlation with other asset classes, and inflation protection. So to do that, we strip out a whole bunch of things that other people consider to be infrastructure. So anything that has too much exposure to competition, commodity price risk, and sovereign risk. Because really what we're trying to get to is stable cash flows, underlying cash flows, and inflation-protected cash flows at that. So we want a portfolio that should be able to provide consistent returns through time, through a cycle. So we describe it as not get rich quick, but it's about growing wealth with a high degree of certainty over the medium to long term. So
Right. And the ones that you got linkages to commodities and what sort of assets are we talking about there that you exclude?
There's quite a few. So on, for example, there's in a commodity sense, there's a bunch of companies in the US in particular, North America, Canada as well, that are often classified as infrastructure. So you have effectively all pipeline companies, guys like Kinder Morgan, Williams Company, etc. And really, when you look at their underlying earnings streams, they have very strong commodity linkages. So Kinder Morgan has a division that pumps oil out of the ground and sells it. So it's clearly got linkages to commodity prices. Williams Company has a business where it fractionates natural gas liquids, it processes natural gas liquids out of a gas stream, and effectively gets paid in part by taking a share of the profits from that. Cheniere Energy has done extraordinarily well the last couple of years. It's a natural gas exporter, LNG exporter.
Yep.
It takes a big chunk of its revenue. 15% is actually it takes on book and sells. So clearly that's a big chunk of revenue that's exposed to the LNG price. Plus it takes a clip of the ticket on another large chunk of its business. So about a third of its business is actually a pass-through, and the rest of it is taking direct commodity price risk. We don't like that because commodity prices are pretty volatile, as we've seen. And effectively, if you're trying to get a portfolio with stable cash flows through time, commodity prices isn't that. Another way to think about it, also things we exclude in terms of competition and commodity prices as well, things like power generators. So to the extent they're not regulated, you're exposed to the power price.
Yep.
Power price varies significantly. I think the range last year was about $14,500 a megawatt hour at the top end to minus $500 a megawatt hour. So you're selling power at a loss. Clearly, cash flows aren't reliable in that environment. Plus, you're taking input price risk. To the extent you've sold power forward, then if your commodity price goes up, your input costs are coal, gas, etc., then you're weighing that risk as well. And the same on the retail side of that business. So we're like a bit in the middle, the regulated poles and wires. very stable returns through time. We're comfortable with that. And on the sovereign risk front, things like China, Russia, Indonesia, anywhere we're not confident in the rule of law. And that's really about, again, trying to get to the cause of stability in the underlying cash flow streams. Like China's got fantastic dynamics in terms of growing wealth and car penetration and population mobility into the cities. The problem we have is the government has an unfortunate habit of interfering in the property rights of private investors. The governments try that all over the world because they see the great cash flows that these things generate. The problem is you can't really take the Chinese government to court and win. So there's multiple examples of them, making public holidays toll-free in China on toll roads. And that's great for public policy, but if it happened in Australia or the UK or the US, you'd expect compensation for that. But you can't get that in China.
Ofer, with when market correct and we have crackers and we're talking about listed assets and infrastructure businesses, generally everything seems to when the markets fall, everything, there's no place to hide, everything comes down with it. But how, over obviously a longer duration rather than just a crash or correction, how do we find that infrastructure assets are, and your fund particularly, is reacting overall compared to other businesses that we're probably more used to talking about?
But generally, we would expect the fall to be about 30 to 40% of the general market. So we sort of call it downside capture. So in the months that the market's down, we tend to be down 30 to 40% as much. In the last, we track it over 5-year periods. Over the last 5 years, it's a bit hard, and that's about 50%, and that's because it's capturing COVID. And COVID was a pretty unique circumstance where things like airports and toll roads really took a big hit because of the nature of their businesses, that they effectively weren't earning revenue or earning very limited revenue for a couple of years, and that's why they overreacted in that sense.
And is there a price to pay? Obviously, you don't cop as much on the downside. Is there a price to pay on the upside that you...
Yeah, of course. We wouldn't expect to capture all the upside in a strongly rising market, but I think through the cycle, we expect to perform well. We target sort of CPI plus 5 through the investment cycle. Again, not get rich quick, but providing that stability of cash flows, downside protection and diversification, which is what you really should be expecting when you invest in infrastructure.
One thing I've noticed when I've gone through your portfolio and have a look at a lot of the names, and Transurban is obviously at the top of the list there, your last disclosure at the start of the year. Obviously, debt levels seems to be quite high across a lot of infrastructure assets, so the debt, the traditional debt to equity ratio. How do you guys assess that?
So we focus very much on the capability of the companies to repay the debt and the absolute quantum of that debt. So within Transurban, most of the debt is ring-fenced within the assets themselves, so non-recourse debt. But ultimately, the ability, the ICR, the ability to pay back the debt is key, it's critical. And generally speaking, because the cash flows are so reliable, these things can actually carry more debt than general industrial company. You have a lot more confidence in the ability to pay it back. Even during COVID, most of these guys were not stressed at all in terms of paying back their debt. So they can afford to pay it back. They're not overly geared. From an equity point of view, book equity might not be the best metric either, because effectively when you build a toll road, you spend a lot of money up front and you have large depreciation losses. So it's not reflective of the underlying cash flow of the business. So really what you want to do is look at the ability to repay rather than a book equity kind of metric.
And just on new investments, when you're looking at an infrastructure business and there's obviously greenfields, brownfields, and then operating assets, is there a sort of mix that you're looking for that they've got new projects in the pipeline with seasoned cash cows that just keep delivering?
Yeah, generally we like the brownfield assets more than the greenfield. There's obviously more risk associated with the greenfield. Within toll roads, there's obviously construction risk, for example, and we actually handicap companies with large amounts of construction risk within those businesses. If you're building new assets, there's cost overrun risk, which unfortunately played out for Transurban in terms of the Westgate Tunnel. But brownfield is good. You see the cash pattern is established. Within toll roads themselves, there's something pretty unique in the toll road, that there's a huge amount of option value inherent in those assets that you can't really capture in evaluation. So no one else can buy in the M7 that Transurban owns in Sydney or any of their other roads without them agreeing, and they get paid to do that, whether it's higher tolls or concession extensions or Westgate Tunnel was paid for by increasing toll on the Sea-Link toll road in Melbourne. The North Connect road was paid for in part by raising tolls on the M7. It's hard to value those kinds of things. So But ultimately, we like those kind of incremental growth projects. We're a bit more cautious about the greenfield development projects because there's more risk associated with them. But to the extent you have a competitive advantage and you can offset a lot of that risk, then we're happy with that.
Can you just help me understand the definition between greenfields and brownfields, please?
So a greenfield toll road is something you're effectively building from scratch. So to the extent there's no existing road there, or there's a existing road that isn't a toll road and you need major works to upgrade it and widen it, etc. A brownfield is the existing road that already has a traffic pattern established, very little construction risk associated with it.
That's where the government is often on selling to a private regulator to get the upgrade that the community needs.
Link initially was the Tulla Freeway, part of Tulla Freeway. That road was widened and upgraded to create the Western Link in Melbourne, and they obviously built the Burnley Tunnel, upgraded the Monash Freeway to create the whole Southern Link network as well. So they're on an existing road, but there's part of it was greenfield, part of it was brownfield, effectively for that one. Things like the Lane Cove Tunnel across City Tunnel, no existing road was there, they had to be built. Even M7, no existing road was there, they had to be built. You're taking a bit more risk on those kinds of developments.
Ofer, you mentioned that they're sort of transurban. They're taking cash flow and profit from one asset to help build the next one. So in terms of payout ratio from a distribution of the investor receives a dividend, what's generally an average payout ratio of?
So Transurban pays out 100% of underlying cash. This year paid out a little bit more because they raised some equity to fund a stake in WestConnex in Sydney, and said we'll try and effectively keep shareholders whole in terms of the dividend, and we'll pay out a little bit from those regearings. But what they're paying out is underlying cash flow from the business, 100% of underlying cash flow. Then they use the refinancings to help fund development. And to the extent they buy a new asset, so they're looking at Connect East, they may have to raise equity to pay for that as well.
I think over 100% of their profit worry you longer. It doesn't worry you in the short term, but medium term it would.
It would if it did. For long term, it would, and that was part of the problem with the model that happened from the early 2000s. Was they were re-gearing heavily and paying out cash flow up front, and that exposed them significantly more to they were much more heavily geared, and exposed them more to risks around demand shocks. So this is a much more stable model where you're paying underlying cash flow out, and that's fine. These businesses generate a lot of cash because you spend most of the money up front, effectively, and that's what it's designed to do.
Is there still lots of opportunity for these brownfield projects to come online as these businesses are doing deals with governments around the world?
Yeah. So there's lots of projects that can be done, even within the existing networks. Again, the M7 is an agreement to widen that. We consider that to be brownfield. It's kind of, there's some construction risk, but it's within an existing traffic pattern that we understand. There's not a lot of risk around the construction of that. Logan Motorway, some of the Queensland roads can be upgraded as well. They've done a number of widenings to existing roads, but governments all over the world find they're struggling for cash, and they want to do these projects. So more recently, Maryland's was a project that fell over, unfortunately, on cost over environmental delays and political objections. But that was an existing road that needed to be effectively widened and upgraded to put in hot lanes or high frequency toll lanes. We did something similar in Virginia. There's the existing hot lanes in the Capital Beltway and the I-95. They upgraded those. So the brownfield, effectively a brownfield road, very little construction risk or limited construction risk. And then they effectively were able to monetize those assets.
Right. Just switching tack now a bit off of inflation, obviously being a big issue and something that it's affecting everyone at the moment with interest rates. But in terms of protection for infrastructure assets, and obviously the deals they do with the governments to provide that protection, can you give us a bit of an outline of what you guys are looking for and what deals get done at a very high level to provide businesses and investors protection?
So a lot of that is done at the outset. So let's step back. So there's two parts, the utilities and infrastructure. The utilities, it comes down to the regulatory construct that exists. So for the most part, utilities get to pass through their costs. So when you think about the way a proper regulated utility works, is they have a cost and an allowed return on equity, and a regulated asset base or an allowed return on equity. So you end up with how much profit should these guys be making, and you build back up to the revenue requirement to get there. You work out what the costs are, etc. So as debt costs go up, as inflation goes up, you get to pass those through to make sure you're kept whole on your return on equity. Maybe some a bit narrow band around that, but effectively you're kept whole.
Right.
So utilities, by and large, are pretty safe.
Yeah.
It could be lags depending on the jurisdiction, but you effectively pass it through. For infrastructure, it depends very much on the type of asset. So for toll roads, the deal that's done is done at the outset. So when the toll road is the first set up, the contract specifies how you can raise tolls. And in most cases, those are inflation linked, whether 100% or part thereof. So ALX owns APRR in France, or it's taken that, and they pass on 70% of inflation, effectively.
Okay.
So they get to benefit from rising inflation. The costs don't rise to the same degree, generally speaking, because their margins are quite high, effectively. So you're relatively well protected from inflation. Or for toll roads, you're extremely well protected. It's generally a pretty clear pass-through. Airports, you have a regulated part of the business. So that's the aeronautical business. So that's putting people onto planes, charging the airlines to do that, running the terminals, etc. So that's generally regulated or light-handed regulated. Again, you have a pass-through of inflation, potentially with some lag, but generally it's a pass-through of inflation. The unregulated part of the business, that's effectively the shopping centre that's attached to the airport. So if you've been to Sydney Airport or Melbourne Airport, you walk in, there's a huge duty-free shop, there's a bunch of retailers, there's food and beverage operators. That's unregulated. The model there is they have a clip of the ticket, they take a share of revenue, subject to a minimum rent. So as those guys raise their prices, your revenue goes up with that. Your costs don't go up nearly the same rate. You actually benefit from inflation on that part of the business. And the other part of the business is generally property rentals, and most of those are inflation linked. Again, you're pretty protected there. Moving down the scale, things like rail's about a pricing power story. So there's what rails we invest in the North American Class 1 railroads, effectively duopolies in Canada, then two on the East Coast and two on the West Coast of America. They're pretty stable duopolies, and effectively, to the extent costs go up, they're able to pass those through to the customers. Customers generally don't have a huge amount of option in terms of switching between them, because effectively, if you're long hauling freight or coal or other goods, the cost on a truck is much higher than the cost on rail. So they're not rapacious in terms of pushing the market power, but they are able to pass through their costs effectively. The weakest link is probably tower companies and communications towers. So that is telecom towers. You see them in the street, you walk out, look up, you see a big tower with bits of equipment on it. Yep. Think of that as kind of vertical real estate. In the US, they lease out the tower space to the AT&Ts and the Verizons of the world. But effectively, those contracts tend to be fixed escalator contracts. They're raising prices at 3% per annum on those contracts. So they're a little bit inflation exposed, or they are inflation exposed, particularly if inflation is above 3%. And we've spoken to the companies and sort of said, look, again, it's very difficult to move towers as a telecoms provider. You move one, you're going to move multiple sites. You have long-term contracts in place. Why have you not thought about moving to CPI linked? Europe is predominantly CPI linked. And the answer is pretty good. It's, well, if you believe the Fed, they're going to get inflation back to the target band of 2-3%. It's been under 3% for the last 20 years. We're getting real price increases of 20 years. So why would we, for a short period of time, we think 2 years, 3 years of above 3% price increases or inflation increases above 3%, if that's going to get back to below and we can have another 20 years of above inflation price increases, why wouldn't we do that? That's pretty sensible. Right. Underlying that business as well, just say there's a huge drive to increase the number of cell sites. Think about how much data that gets used today versus 10 years ago. Even whether you had a BlackBerry 10 years ago, I had a BlackBerry. Scrolling through your emails, you kind of don't use a lot of data. But now you look, walk down the street or sit at the bus stop and someone's watching Netflix on their phone. Yep. That data intensity means you've got to put up more cell sites, you've got to put up more equipment. So these guys are growing their underlying business footprint significantly. So I think Ericsson had 32% CAGR to 2028 from 22 to 28 of volume of data going through telecom systems. And that data needs to go somewhere. And if you've been to the footy and you get your phone out and nothing happens because everyone else has their phone out at the same time, well, that's because there's network congestion. You solve that by putting out more cell sites. So there's a huge tailwind to growth. But right at this point in time, they're kind of underperforming on the back of inflation's above where they're pricing. So.
Right. And what businesses are you guys interested in that space at the moment? What's out in the portfolio when it comes to telecom and
It's
delivery
up
of
in
this?
towers. It's only tower businesses. It's not the operators. The operators for us are competitive. So
Yep.
it's American Tower and Crown Castle, the two biggest US tower companies. So again, very American Tower has most of their business in the US, but they have some international business as well. Where Crown Castle is very focused on the US.
And where does cloud storage fit within infrastructure, or is that sort of not
Yeah.
separate businesses or more hidden within
Separate
Amazon and
businesses
Google?
for us. So I mean, the big data centers we've looked at a couple of times. For us, it's effectively industrial property. Once you build one big data center, there's nothing that stops someone else building one right next door. So
Yep.
if you could invest just in the data center next to the stock exchange, that has a competitive advantage, and everyone wants to plug into that. If we can invest in that, that'd be infrastructure. The one out in the middle of nowhere in a big field, that's competitive. And we've looked at it a couple of times, and the margins aren't fantastic. They're growing significantly.
Yes.
But the business model is competitive. So
Right.
for us, we can't get across the line on it.
Right. So, are there any other assets for the new digital world that we're moving into, where obviously it's obviously the data stream, the towers, yes, but are there any other obviously future assets that we should be thinking about or aware of?
Now, we're always on the lookout for new assets, and we've kind of looked at the internet registry, came close to that. Couldn't quite get there, just on the risk profile, on the way it's regulated. But for the most part, we always keep an eye out, but it's hard to replicate the monopoly characteristics of these asset classes.
Yes.
So
Yes.
when new things come out, they tend to be quite competitive. So to the extent we see them and we like the business models and we get comfort around the duration of cash flows and stability of cash flows, then we'd look at them and try and include them if we could.
There's been much exposure, obviously, gas prices over in Europe because of the war. Is that affected many of the companies that you guys currently own?
Yeah, not really, because we're on the regulated side, we don't take the commodity price risk.
Yep.
I think so Snam, Renegas in Italy, for example, I think it's multi-billion dollars in revenue, and it has, I think, something like $15 million of revenue associated with the gas price itself. So very, very small.
Yep.
Don't call me the exact numbers, but minimal exposure to the underlying gas price. So again, for these guys, it's a pass-through. It's not an actual a cost to them. Where it can affect you, for example, in the US, when electricity prices go up or gas prices go up, you're passing it through. It's not your cost directly, but customers, you're facing the customer. So in the US, the model is obviously often an end-to-end regulated utility. You're there from generation all the way to the customer, or if you're a gas pipeline company, they get the bill from Atmos Energy in the US. We don't own Atmos at the moment, by the way.
Yeah.
But to the extent that you're the person they're seeing the increased bill from, they cop political ire. So I've seen Eversource in the US cop some political ire over higher electricity prices, but they're not the cause of it. But that's a social license risk, and that's dealing with political risk and trying to deal with those elements of the equation that they have to in terms of regulation.
Right. Oh, you've used the term pass-through quite a few times. That's essentially saying that if there's a pipe, the product is passing through and they're paying for that facility. The people that owns the pipe have got no ownership in the commodity itself.
Correct. That's correct. Yeah.
Fantastic.
So for an electricity, for example, to the extent that electricity prices go up, the wholesale price gets passed through to the customer, and you don't make a margin on the electricity. Gas, likewise, you're not making a margin on the gas. You're just simply transporting it from point A to point B.
Right. So talking about electricity, and obviously there's been a lot of, I suppose, stuff in the news where South Australia had their issue with power outages, and Musk stepped in with an awesome battery pack out in the desert. Is that a space where you see future opportunity?
Yeah, that's in a lot of regions. That's falling into the regulated utility scope. So Turner in Italy, the system operator is building batteries. Some of the US companies are building batteries as part of their regulated solution to the regulated generation solution. So you're building more wind, more solar, and they're building batteries as part of it. The whole shift to net zero, or the push to net zero, is throwing up actually really good opportunities for these companies, not just batteries, but if you think about the way they're regulated. Again, I mentioned before, they pass through their costs. So operating costs are a pass-through. You're working out on your asset base, your net assets. You ultimately get a return on that, allowed return, a fair return on capital. If you're running a coal plant or a gas plant, you have high operations and maintenance costs. You have input costs of the coal, the gas, the facility it runs at high temperature. There's a lot of costs associated with that. You replace that with a wind farm or a solar plant, the marginal costs are very, very low, near zero.
Yep.
But what you've done is replace operations and maintenance cost with capital, and you get a return on that capital. So all of a sudden, you're actually improving your return profile, and you're effectively potentially even lowering the customer bills, or not necessarily raising the customer bills, but you're enhancing your returns. Right. So to give you an idea of the scope, the quantum of this this opportunity, Princeton put out a study in 21. Their estimate was between $5.9 and $9.8 trillion. The T needs to be spent on transmission and generation alone in the US to reach net zero. Doesn't include distribution, and so these companies need to spend that money to reach net zero goals.
Yep.
And you think, okay, well, what does that mean for customer bills? Well, customer bills will go up again. You're replacing capital with so operations and maintenance costs with capital. You can do that at about a 9 to 1, 10 to 1 ratio, effectively without hurting customer bills. But people, prices going up. Will politicians stop them from investing to try and get relieve bill pressure? If you think about globally, about a quarter of the world's emissions come from generation. If you want to move to net zero, the other 75%, the solution for that is electrification. So you have to solve that 25% piece to meet your net zero targets. Otherwise, you can't take carbon out of the rest of the economy. So there could be delays over very short term, but ultimately these guys are going to be able to transition because they have to make the rest of the economy work. And if you have an electric vehicle, that's great. But if a coal plant's firing up the electricity to power that, you're not doing what you could in the full sense.
Yep. So obviously, huge spend on to get to net zero. But you guys aren't looking for the businesses that are owning the solar farms or the wind farms. You're more interested in the distribution, the pass through of the
to the extent that in the US they're regulated, we're happy with that. To the extent they have very, very long contract lives, so we have a lot of confidence around the cash flows within their 15, 20-year PPAs. We can get comfortable with that as well.
Yep.
What we don't want to do is have the merchant price risk. We don't want to have the guys who are selling power into the spot market, which can be negative or can be very hard depending on what's happening, or if the sun's shining, the wind's blowing, or we don't want to take that kind of risk. That really affects the cash flows. But very long-term contracted assets or very highly regulated assets, we like those.
What's the sector in infrastructure that excites you most for the next coming 10 years?
The whole thing varies significantly depending on the outlook from where we are and depending on what happens over the next couple of years. So I think airports, particularly, the recovery has been extraordinary. I think one airline executive I spoke to framed it as it's been better than anyone ever hoped to dream, I think is the quote. So no one has expected the recovery to be so quick. We've had a huge amount of pent-up demand. We've had strong consumer balance sheets really helping as well. And what that's meant is people want to travel. Particularly leisure has come back extraordinarily quickly.
Yep.
But the leisure-focused airports we own, so AENA, which is the Spanish airport network operator, and ANA, for example, owns the Portuguese airports through Vinci. They are back above 2019 levels of traffic already, and their outlook continues to improve. So people want to travel. I think people have been pretty bearish on that, and there's been supply chain bottlenecks in terms of aircraft availability and other issues as well. I think they'll continue to grow and come back quite strongly over the next few years. Toll roads, again, it's stable cash flows, it's growth. One of the reasons I mentioned the economic situation is these are pretty resilient assets regardless of the economy. That's why we like them. But governments are more inclined to either sell assets when they're stressed, so when government balance sheets are under stress, so more assets could come to market, or potentially offer these guys incentives to go out and build or construct things. So we saw in 2015 in France, the government authorised big spending packages from the toll road companies, and they gave them concession extensions as compensation to help stimulate the economy. And we could see that again. Likewise, in 2008, 2009, we saw allowed returns kind of coming off a bit in 2008 as the markets fell, but then pretty quickly by 2009 we're back above 2007 levels because they're incentivized to go out and spend to create jobs. So there's a little bit of to and fro about how you get there and where you land in terms of the economy. But ultimately, the cash flow should be pretty robust.
Yeah, fantastic. Last question, Ofer, and more general, probably for you as an investor is, we've heard a lot of portfolio managers talk about Warren Buffett, and we've all done lots of reading on that. And I suppose, what's your key takeout from all the quotes, all the readings that we've all done on Buffett and Munger for that matter?
It's about patience and long-term mindset. I think is critical to what we do. And I think his rule one is don't lose money, and rule two is remember rule one. Coming back to the way we invest and way you think about it, our objectives are CPI plus 5 through the investment cycle. So again, not get rich quick. It's long-term, reliable growth through time. And number two is downside protection. We want to minimise permanent loss of capital. If you think about this in a very simple context, if you lose 50% of your value, you need to make 100% to get back to where you were. So protecting capital on downside is really important to ultimately growing wealth over time. That's kind of how we frame our problems and how we think about all the things we look at in terms of risk to cash flow, and that's how we think about our universe.
I will throw one extra question off just on comparing listed property to listed infrastructure. Where's the differences there in terms of risk and growth and dividends?
So dividend for us is not input into our process in terms of stock selection. We look at total return for a start. In terms of property, it's different in terms of the opportunity. You build a block and you lease it out, you're exposed to lease rate. Depending on the kind of property, you're exposed to differences in return profiles. So office might not be the greatest place to be at the moment, given what's happened with COVID. Infrastructure should be more resilient through an investment cycle, as in you're less exposed to industrial property or to offices potentially in recession. It's people going around their everyday lives. It's things that are essential for the efficient functioning community, and the ability to grow revenue as well through time is probably better. You're not strictly tied into long-term leases. You have the ability to participate through population growth, through enhancement of demand, through growing your asset base in terms of utilities, for example. So different profiles, you're growing more growth opportunities and a chance to earn above cost of capital for much longer periods of time, particularly on the infrastructure side rather than the utility side. So that's sort of the key differences for us.
Thanks very much for joining us, Karliner. Appreciate your time and your passion for your job.
Thank you very much, Rob.
No worries. Thanks, mate.
See you later. Bye.